for the purpose of if everything is going wrong, that's what an emergency fund is for. And it's protecting you from the event that the market's down, you lost your job, everything has gone according to the opposite of your plan.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business. The advisors discuss some of our firm's investment processes. These are just a few of the many possible approaches to investing. Individual results may vary depending on your goals, risk tolerance, market conditions, and other personal factors. Please consult a qualified financial professional before implementing any investment strategy.
Welcome to the Market Moment. This is Matt, joined by Eli.
As always, happy to be here.
And John.
Good morning.
All right. We're excited to be here. We have fun. We have fun with these. A lot to get into. Like we've been doing for the last month or two, we're going to start with a frequently asked question. And so today's question is, I don't even know how to pose it, but how do I know if I have an adequate emergency fund, both like before retirement and during retirement, and how much should that be? What does that look like?
Mm-hmm. And probably on top of that, when is a good time to transition between a small emergency fund to a larger emergency fund? And when can you go from larger to smaller? Yeah, because there's different instances where I might recommend someone hold a smaller amount in an emergency fund because they're in a lower risk portion of their plan.
Right.
And then there's some that are in a much higher risk, very volatile part of their plan. And we may recommend a year to 2 years worth of cash as an emergency fund.
Yeah, a lot of it depends on how steady and consistent and quote unquote guaranteed your income sources are, So initial thoughts on, well, let me start with this. So emergency fund, when you think about it, this is kind of going back to the Dave Ramsey approach, right? Yeah. It's like baby step number one. But there's a lot of truth to it. It is really the foundation of your financial plan, because a good, well-funded emergency fund is and often can be the one thing that keeps you from having to change the rest of your plan when things happen. Like when life happens, when the AC goes out, when the car goes down. If you don't have the emergency fund that you need, you're often having to like tweak or pull money from places that you hadn't anticipated needing to, which starts to affect the plan over time, especially if you're having to do that consistently year after year. So really the emergency fund being funded is the foundation, no matter what your net worth is, to a good rock solid financial plan.
And let's be very clear, an emergency fund is cash.
Right.
It's cash that's in a bank account, cash that's in a high yield savings account.
Under your pillow.
It is not access to capital.
Correct.
So if you're considering a taxable brokerage account that's invested in equities as an emergency fund, that's not an emergency fund.
That's not how we would define it. Correct.
For the purpose of if everything is going wrong, that's what an emergency fund is for.
Right.
And it's protecting you from the event that the market's down, you lost your job, everything has gone according to the opposite of your plan, and now you use the emergency fund.
And a lot of people think, and I get it, I mean, they think, well, I'm leaving money on the table, especially if that emergency fund needs to be larger, like 6-12 months, and you're like, man, I'm leaving $150,000 sitting in this account in my emergency fund when I could be making X. But the right way to think about it is, but how many bad decisions is that helping you avoid? And how much better are you able to stay fully invested because you have that 150? So I think for a lot of people, it actually can, over time, enhance your overall returns, even though when you look at that one particular sleeve or part of the plan, you might look and like, well, I'm making 1.5% in a savings account, which if you are right now, you should go get a better savings account. But yeah, it can actually enhance and make your overall returns better because you avoid bad, poor timing and decisions that,
Morgan Housel speaks to that in his book Psychology of Money, which if you have not read, it's a wonderful book that's well worth your time to read. Really easy. He writes in stories, so it's not a difficult read. But he talks about how cash can have a much higher return, just like you're referring to. Cash can have a much higher return than what it actually is, because it affords you to make good decisions. It also affords you, if the market is down, you have a bucket that you can get to before you have to touch the market or before you make an irrational decision with your investments. So the buffer that cash can create can actually enhance returns because it's decreasing bad decisions.
So I'm going to put it in a form of like when we're talking to a client. So I had a young client in yesterday, young couple. They just got married, very young, and they're doing really well, and they're putting money away. And then she wanted to invest. She wanted to talk about getting this money to work, what we're talking about, right? And it was not enough for me to tell her that she should put it to work because it wasn't quite to the level of an emergency fund, right? So the conversation was build that emergency fund, get it to the level that, and this is where I'm a little bit different on that magic number that it's, I mean, yes, as we do planning and we get close to retirement, we can define a number a lot of times, and that's 6 months, 6 times your salary, a year of times your salary, whatever. But in this case, I just wanted her to get to, and her husband, get to a level of, and I'll use an example, and I told her this, like, get this emergency fund, which they're almost there, to $30,000. This is an example. Get it to 30, and that's really comfortable for them, right? It's half of their annual salary, okay? Which is 6 months of, okay. So once you get it to 30, though, then continue to add to that, and when you get it to 40, and nothing's happened, you didn't need to use it or whatever, then you can sweep 10 to a non-qualified investment account and start investing. And then do the exact same thing again. Get it to 40, sweep the 10. Get it to 40, sweep the 10. It's kind of a cool way of like keeping your emergency fund at a level, but then you can still get money to work for you. And the reason why I say always go above that line before you sweep it over there, because you're going to have events.
Things come up.
Heater,
Yeah, because what
like
happens if you want to maintain a fully funded emergency fund, often what happens is if you're not taking that approach, which I think that's actually a really good approach, and I don't always recommend people do it that way, but is something happens, so you pull the 30 down to 25, and then you're kind of scrambling to like, well, how do we get back to 30?
Rebuild.
Versus if, in your example, if you're putting it there first, something happens, and now you have 35. Okay, now we're only sweeping 5 over.
Yeah.
But we've always maintained our 30. So that's kind of an interesting approach.
And as they grow, they have kids and stuff, I kind of encourage her, because they're not going to have kids for several years, and they're making enough to get this to this level pretty fast. When you have kids, maybe increase that line to 40, or because you might have emergencies with the kids, or increase it to 50. As you're getting more income, as things change, you can always change the way you're doing that. But I also think, like we've always talked about this, your buckets of money when you're trying to get to retirement. You have a non-qualified bucket, you have a IRA bucket, that's your 401k or whatever, and then young people for sure should have a Roth bucket. And if you can get that through your 401k, that's great. But the emergency cash, in my opinion, is kind of part of that non-qualified bucket. I know it's a subset of the non-qualified assets, but as you're building assets in the non-qualified and you have the emergency fund, you can kind of see those things growing, and it becomes almost like a game, and you keep that one at 40 or 30 or 50 or whatever that number is, and you sweep over to that brokerage. Now, if you have market downturns, whatever, if you're building your thing up a little bit and you're younger, there's advantages you could take too. If you don't need to take the money, your job is steady, you can sweep some money out and buy more stock.
Now John's talking about timing the market.
Well, I'm just saying, like, there's a lot of fun things you can do.
We went from
this.
emergency fund savings to let's time the market.
No, I'm just saying, like,
I'm kidding.
as you're building these buckets,
It gives you
if
options.
you're disciplined,
No, it
it's
gives you
great.
options.
It gives you options.
Yes.
Yeah, that's all I'm saying.
100%.
And I think there were several things that you said just throughout your conversation that are worth pointing out, is that as life changes, as circumstances change, there could be a need to change your emergency fund. So there's a couple that come to mind as I'm thinking through that. If you are single, you have no dependents, and you have a really steady job, one that layoffs don't happen consistently around you, well then 3 months emergency fund is going to be an ample emergency fund. Likely not going to lose your job. You don't have anyone relying on you. You have very little debts. Like it's an easy thing to say, okay, 3 months emergency fund makes sense for that circumstance. Then you start to transition into, okay, now 4, 5, 6, maybe plus months emergency fund starts to come in when dependents start to come in into your life. And then you're married, you have a risky job. Like there are some positions just by nature that are more volatile incomes. If you have high and low years of incomes, right. If you have a place that lays off regularly, or if you're the sole provider versus you're both high income earners. Mm-hmm. If both are high income earners, maybe you can dial it back on the emergency fund. So that's where kind of baseline for me whenever we're building plans is similar to what you said. Somewhere in that like 3 months range is baseline with low risk.
Yeah.
you start to introduce variables of risk, and then we're starting to ramp that up, especially for pre-retirees.
Yeah. So if you're out there and you're like, man, I really haven't ever thought through this or haven't funded an emergency fund, one of the worst things you can do when you're thinking through investing and financial planning is overthink it. It's kind of the paralysis analysis, right? And so just say, hey, 3 to 6 months. Just pick one and work towards it. Yeah. And then as you're working towards it, you can start to learn and figure out where do I need to land here? Am I okay? But don't sit and try to figure out, like, because take action.
Yeah,
right?
exactly.
Before you feel like you have to have it perfectly defined. I've always said, 3 to 6 months is a great range that applies to a broad, range of people. So
when would you start to recommend someone goes further than 6 months?
So I think we've talked about like the retirement red zone as you're approaching retirement. I think as you're getting close to retirement, kind of depending on where your income is going to be coming from in retirement
and your age of retirement.
I think that's a season of life that, hey, it may make sense to have a year or two, because we're going through so many changes and our income sources are completely changing, and money's going to be coming from places it's never had to come from before. And so that's a good, not that you'll leave it there forever, but through that kind of season of life. If you're wanting to change jobs, if you're wanting to start a business, if you're wanting to start a family, anytime there's just a lot of unknowns, I think that's a time to say, like, hey, maybe before we get this or before we implement, like, let's ramp up our emergency funds to give us more cushion.
Yeah, if you're you're going to buy a house in 2 years, or the plan is, or whatever, you can start ramping it up as a savings / not in the market, not taking the risk, and so you're kind of in a way making an emergency fund, but it's really for something else. But also, like, if you're going to retire before 59 and a half, and you have a lot of assets in traditional IRA, you need to have money to bridge the gap between that age and 59 and a half when you can take it without penalty. Those are kind of areas. If you're not going to start Social Security, if you want to hold off Social Security, you're going to retire at 65, but you want to wait till 67, it's a good idea to start ramping up that so you're not having to touch things before the Social Security benefit starts. I mean, little things like that, but it's all relative to the plan.
What I'm somewhat hearing, if I was to summarize what you guys just said, is in the years that you anticipate large cash withdrawals or large withdrawals from a retirement portfolio are the years in which you should consider increasing your allocation or increasing how much you hold in cash.
It's almost taking risk off.
Yeah.
Right? Yeah.
And is there ever a time that you guys might consider doing less than 3 months?
Only if you had non-qualified assets that you could get hit, almost like a default emergency fund. Right? So I'd say 3 months is like the minimum you should have, in my opinion.
Yeah, I mean, I'm sure there's a case or scenario out there,
but it's niche.
Yeah, I mean, nothing that just comes to mind that, like, oh, we consistently see this, and I tell people to have less than
literally
that.
The only example that comes to my mind is a couple that I met with. They have $230,000 of pensions, both guaranteed by the PBGC. It's like both insured pensions, both lasting as long as both of them live. Like, there's a case to say emergency funds are just less necessary.
Right.
Yeah.
Right.
Like in a circumstance like that.
Yeah, because they're getting that for life. Yeah.
Yeah. Okay.
All right.
Well, good conversation. So, emergency fund, foundation of your financial plan. It's the simplest, easiest part, but it is potentially the most important part of
and often overlooked.
Yeah, of your financial plan. So, think through that and have a plan on how to handle that for your situation. So, today we're going to just kind of talk about what's out in front of everybody on the major headlines. So we've got a kind of looming government shutdown. I feel like this is like a recycling news story every like 6 months that we just pop up. It's like, oh, our government can't get along and figure things out and pay for itself. So
I've got a couple tidbits for you, Matt.
Yeah, so like government shutdown. So John, you were looking at kind of government shutdowns, what that means in terms of recessions or markets and what it doesn't mean. And so
well, in the past 30 years, the government has shut down for a grand total of 80 days.
The past 30 years, you said?
The last 30 years,
okay.
Right? There has been no recession in any of those 80 days, right? So this talk of, like, if we go into government shutdown, it's going to create a recession.
Historically, that's not been the case.
Historically, that's not the case. So nor is a shutdown going to lead to some sort of emergency. The Treasury Department would still receive revenue, and entitlement payments would still go out for Social Security, Medicare, and Medicaid. So this fear that some of those things are going to be cut off, no fear. Sorry. Treasury bondholders would get paid in full, both principal and interest. The military, Border Patrol, Weather Service, FAA, Post Office, among other operations, will still continue. Okay? What would be shut down, what would make the shutdown difference? And this is kind of interesting from the Trump administration, the pressure he's putting on the Democrats to make a deal. Typically, non-essential employees get sent home during a shutdown.
Yeah.
When they come back, they get back pay. This time is different. Trump is saying non-essential employees, when they go home, maybe we should just permanently let them go. They're non-essential. And it's kind of an interesting argument.
Yeah,
right?
you don't. It's like you never want to like make light or joke about someone's job.
It's terrible.
But when you think of like if there were ever an entity agency that shouldn't have bloated employee count, that's
our federal
they
government.
themselves are defining as non-essential.
Yeah.
It's the federal government.
100%. We've bloated this thing out over hundreds of
so
years.
Anyway, I don't know anything about that, but that's interesting.
Well, I think that's a fight, and I think the Democrats have to choose between, because it's kind of like, even though it be from Donald Trump, which is but they, you know, how the political football goes, right? It could be put on them that they, because they didn't come to the table, they had government employees fired, right?
Yeah.
I mean, which is, you know, semantics. But the point is, it's an interesting tactic from Trump to try to get the government shutdown to not happen.
Sure.
Right? I find it kind of interesting. But anyway, I think the main concern on the government shutdown is that my Social Security check's not going to come, or Medicare's not going to pay, or Medicaid, and that is just not the case. Those things will continue to go, and I think that's the most important thing. And then you can hear from political, you know, and I call them lackeys, that will threaten that type of stuff to make people fear, but that is not what happens in a government shutdown. Mm-hmm. So there you go. That's the answer of the government shutdown. That's all I got.
So really, it's a lot of fear for very little action.
I mean,
very little
yes,
that's actually
exactly.
happen.
Yeah,
Exactly.
Yeah, I think that's true, and that's been true, you know, and it probably will be true. I guess the scenario that it's like, it's just how long do they let it stay shut down?
Right.
Because the duration of that, then you start getting into maybe scenarios we haven't experienced before, or don't have as much of historical perspective of the impact. I would imagine that even if it, you know, shuts down, the clock really starts ticking, and they're not going to let that go on for too long. But
I would think so.
I also know that there is an immense amount of hatred towards the current administration.
Right.
And
Right.
so, you know, that would be my one concern, is just like
that we can't get.
how many people want to just dig in their heels to try to make a point, you know, instead of doing what they need to do to figure things out.
I will say these kind of things are amazing to me, because it does open the eyes. And it's not a left or right issue. It's a bloated government issue, which both parties are completely complicit in making happen. So these kind of things, I think the one thing I find different is that the last 80 times there was never the threat to just not have the non-essentials come back.
Yeah.
Right? And so that's different this time. And I do think that will people dig their heels in harder, or you know,
Or get them to the table quicker.
or get them to the table quicker. It's unknown, but I do think it'll eventually solve itself out. Because all of those 80, if you go back and look at the news articles around those previous 80 that happened in the last 30 years, the same exact rhetoric, other than the non-essentials getting their jobs back, but the same exact, you know, anger towards each side, and you know, has always been there, and they've always solved it.
So what about the fear of, like, you've heard and are hearing the kind of the R word again, right? Recession, recessionary fears. So you just told us, just from a historical perspective, you know, we've never had a government shutdown kind of be
create a recession.
be the one, the single event that tips us over and pushes us into a recession. I feel like Zoe and us, you know, we were talking about this before we got on here, for a while now, and going back through COVID and coming out of COVID, and I think you can point to all the way till today, it's like there's been these pockets of recessions taking place, right? Whether it's sectors, industries, certain demographics, right, of people.
Yep.
So I think that's been true, but and what we were talking about is like that could be kind of continue for a while, like where you have these rolling recessions where industries and sectors go through a recession, start coming out of it, then something else is kind of, without having to have a massive overarching, you know, full economic recession. Doesn't mean we won't or could, or, you know, at some point, but I don't see anything, and I would be surprised if the government shutting down was the thing that like tipped us over.
I actually think long term, like cutting government would actually be such a benefit to the economy. We spend so much of our money on the government, and the government, unfortunately, since COVID really has been one of the principal parts of the GDP, which is not healthy.
Yeah.
It's
not
never
sustainable
good.
forever.
Yeah, you cannot
growing.
have that going on forever. So,
Eli?
And a lot of times when we're here in recession, that's a feeling-based motivator, right? Whoever's writing the articles, their family members affected by something, or they have a next door neighbor. You know the story about a recession is when you see people losing their jobs all around you,
Right.
and a depression is when you lose your job.
Right.
And so
That's a great point.
there's a tweet. I love tweets.
Yeah.
Or an X.
X's.
I don't know. But it's from Ben Carlson, who writes A Wealth of Common Sense. And this was this morning,
Okay.
2 hours before we got on here.
okay.
He says, stock market at all-time highs, housing prices at all-time highs, GDP growth at 4%, inflation at 3%, unemployment rate sub 4.5%, wage growth at 4%. Everyone hates this economy.
Yeah.
Dot.
Yeah.
And it's
Yeah.
like if you were to draw this, if you were to whiteboard what I want an economy to be pretty close to,
Yeah.
you'd whiteboard pretty close to these
Right.
data points.
But we fear, it's our fear naturally gets heightened when things are going well.
Yeah.
You know, because we know, and it's true, like they're not going to go well and be perfect forever, right? And so I think people just start getting antsy when things are going well, and it's not going well for everybody, and it's not going perfect.
No.
But things are, relatively solid. Like when you look at it.
When you look at it like that, it's fantastic. I will say this on the unemployment numbers. And I say this because when I don't get a coffee, but my wife gets a coffee, or, if I'm with my son, he gets a coffee, right? And we go into the little local places. And a lot of times the folks that are there to give the coffee, they want to have long conversations with you for some reason, right? And the conversations always lead to always ask back, what are you doing? What's your story? And a lot of them are college grads that can't find a job, but they're not on the unemployment numbers because they're working. And again, I think like the younger 30 and unders, it's not every 30 and under, of course, but there is a segment. We're talking about like a recession I love what Eli said there.
Oh, go ahead.
Because it's a recession, the way he said it is determine how you feel about it. It's relative to how you feel. But I think the under 30 group that are having a hard time getting their jobs that they went to college for, and they have massive college debt, and they have credit card debt and all that stuff, they are feeling a massive pinch.
Well, unemployed
in
and
my opinion.
underemployed are two different things, right?
Totally different.
And the numbers show up different.
Yes.
But yeah, I think for younger people, it is a tough market with AI, the innovation.
Yeah.
I mean, Doug, we're in Walmart country. Doug came out, was it yesterday or the day before, saying AI is going to change every job.
Yep.
He's like, if there's a job AI is not going to change, I just haven't thought of it yet. I mean, that was his quote,
16% of businesses on the S&P 500 have adopted AI. 84% have not.
Yeah.
Now that trend is going to continue to get bigger, which could lead to
so it's going to be hard.
Yeah, it could
for
lead to
people with lack of
employment
experience,
problem.
and
So going off what you said, John, this is from the St. Louis Fed, who puts out a lot of statistics around unemployment. Age 20 to 24-year-olds are at a 9.4% unemployment rate. So that's the college grad years, 20 to 24. As soon as you jump into the 25 years and over, you're at 3.6%.
Okay, so it's not so bad. So maybe the 25 and unders is maybe the more way to look at it versus 30 and unders.
Sorry, I misread that. 25 to 34 is 4.7. So
Okay,
it's
so-
still elevated above. Those younger years are elevated in unemployment.
When you're 25 and you don't have a job from your college, you will go work at a coffee shop or something, right? So it could be there's more underemployed in there. I just worry like that. I think can get fixed though, right? I'm hoping, and some of this AI can lead to other things, right? And there's a ton of opportunity in the traditional electrician,
The trades.
plumber, the trades, which people are starting to go towards.
Plenty.
Yeah, I'm pretty excited. I'm going to say this. I met a young couple yesterday that came in for a first appointment. I was telling you about the savings thing. They did not go to college. One of them is a hairstylist and one of them is an electrician. And the electrician is 2 months away. He's 2 months away from his apprenticeship being over. And I just thought, how cool is that story? He's going to make really good money. They have no debt.
Yeah.
And they're young. So there's ways to get around not having debt and ways to get, and then like they found that cheat code, and we've been programmed to think you have to go to college, you have to have all these things. America's great, but you have to have all, And the reality is a lot of kids are going to be kind of forced, I think, into choosing other things, and it could work out really well for the economy and for younger folks.
Sure. Yeah, it'll
Hopefully.
be interesting as we kind of keep our eye on this government shutdown. Do we fully get there? Do they figure it out right before? Or if we, quote unquote, shut down, how long do they let it last? But so always
Fun.
always fun.
Why'd you look at me and all sigh when you said that?
No, but it's good to know. I didn't know we've been shut down for 80 days over the last 30 years. And so there's some interesting numbers behind what's going on currently. So as always, we appreciate you guys listening. We really have fun doing these. So we appreciate you guys joining us. Give us a like, subscribe, comment, shoot us an email with any questions that you have. And we'll look forward to seeing you guys next week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.